Welcome to our fall 2024 market update. Hope you are doing well. What a year it's been in the markets and in our country with the presidential election that certainly caught most of the news a couple of weeks ago. It's hard to believe how fast time flies. It almost is starting to seem like old news. So we're recording this the week before Thanksgiving, and certainly hope that you are getting ready for very special holiday season with your loved ones. We really just wanted to put together some thoughts near the end of the year and share those with you today as it relates to how to think about your financial plan, your investment portfolio, and what you're trying to accomplish financially in life. Now that the election is over, I really love this quote. It seemed appropriate today. Democracy is the worst form of government known to man, except for all the others. From Winston Churchill. Those of you that listen to these market updates or watch these market updates have seen that quote a time or two before, because it also really has implications as it relates to investing. Sometimes a well-diversified portfolio can be the worst investment strategy known to man, except for all the others. So I really love this chart. The White House has undergone now 8 party transitions since 1972, yet the S&P 500 index has continued to march higher. You can see from this chart, most of the time it's performed pretty well regardless of who's been in power, whether that's in the White House or who's in control of Congress. And obviously, if we only invested when our preferred political party was in power, we would have far less money over the last 50 years than what this chart shows. You know, the Winston Churchill quote certainly applies as we look at this chart too. This is another familiar chart. This is one we show just about every market update. It's got a few moving parts, but if you'll just look to the far right, that shows a 21% increase in the S&P 500 index through the first 3 quarters of this year. The red dot below it that says -8%. We had a decline in the spring. We had another temporary decline in the summer. Yet for 33 out of the last 44 years, the S&P 500 index is still positive. So about 3/4 the time, obviously. And the average decline during the year at some point, the average of all those red dots that you see going back to 1980 is a 14% decline. That would be the equivalent of turning on the news tonight or the next day, depending on when you're listening to this, and the news reporting a 6,000 point drop in the Dow. So please remember that a 6,000 point drop in the Dow, based on where the Dow Jones Industrial Average is right now, that would be considered normal. Or if you consider something that happens every year normal, or on average every year, which I think is a pretty decent definition. All of the leaves are about to fall off these trees this fall, and that also is considered very normal. Yet we don't assume that the trees are dead. So, asset allocation, we believe, still works. In other words, not putting all of your money in the Standard & Poor's 500 index, regardless of your goal. But bonds are up about 3 to 4% through the first 3 quarters of this year. Small and mid-cap and international equities are not quite up 21% like the S&P 500 index, which would be our index for large cap. Small, mid-cap, and international, we're up about 10 to 15%, depending on the asset class, through the first 3 quarters of this year. So we do think that history will repeat itself in some form or fashion, where the S&P 500 index will not be the leader in terms of asset classes for a period of time, but it certainly has been for a number of years now. Speaking of normal, let's look a little more closely at what normal really is. This just puts some numbers to what I just was explaining. Since 1994, the S&P 500 index has averaged about a 10% average annual return. Yet only 5 of the last 30 years or so has it returned anything close to 10%. Sometimes it's much less and negative, as you can see on this chart. And but most of the time, it earns far more than 10%. So we just need to remember that even though 10% is the long-term average on the S&P 500 index, we rarely get a 10% return. Thankfully, things go better more often than they go poorly. When we have a year like 2024, when things have gone pretty well, and you look at a chart like this, and you think back to some of the volatility in 2022 and in 2020, let's not forget there was a 34% decline in the S&P 500 index in 2020, even though the market, that index ended up a positive 16% that year. There's been a lot of volatility in the last 4, 5, 6 years. So it's okay to be grateful and glad in a year like 2024. This is just a really neat chart that I came across recently. It just shows the growth of $100 by asset class from 1970 to 2023. You can see there at the bottom, $100 would have become about $1,000 in cash. $100 worth of the average personal residence in the United States would now be about $1,500. If you wanted to put it in treasury bonds, $100 has become $2,000. You put $100 in gold in 1970, you got about $5,500. Corporate bonds, you're going to have about $7,700, $7,800. And then if you put $100 in the S&P 500 index, you'd have over $22,000. So we just need to remember how powerful it is to be invested in places where people go to work every day and bring their best ideas to produce new goods and services to earn a fair profit. At a very high level, that's about as complicated as it really gets, which is not very complicated. So one last chart for today. This is called win rate by holding period. You know, if you look at the far left, the S&P 500 index on a daily basis is only positive about half the time. That's why it can feel pretty volatile. And then yet if you look on a monthly basis, it's positive about 2/3 of the time almost. And then on an annual basis, it's positive 79% of the time using the data in this graphic. And then once you get to a 2 to 3 to 4 year period, the S&P 500 index is positive 88, 90, 91% of the time, which is just amazing. Back in 2008, I remember people saying, pretty high level investment experts saying it's going to take decades for the market to recover. They also said that after the Great Depression, based on news articles I've read. And yet the reality is that after the two most significant stock market declines of the last 100 years, you did not have to wait decades for your portfolio to rebound. You might have had to wait a few years, and that's as bad as it gets. Sometimes it can be interesting to get perspectives from outside the US. A commentary I read frequently from a colleague included this article headline that caught my attention. The Economist, just published out of London, said the American economy is still the envy of the world. And here were just some of the bullet points from the article. The American economy has left other rich countries in the dust, and we expect that to continue. American productivity still leads the world. The Shale Revolution helped America's economy, helped make America's economy great, while the American stock market reigns supreme, and China's currency is nowhere close to replacing the American dollar. You know, sometimes it's difficult to be patient and feel grateful when, as an American citizen, you're so close to the messiness of it all, just going through a fairly volatile political season. Sometimes the unpredictability of our investment markets can also cause anxiety. But I liked this report, which was actually pre-election. And as we enter this Thanksgiving and holiday season, I think it's good to be glad that both our political and investment market systems certainly do have a way of self-correcting in ways that reward those who are patient. Which really brings us to our last slide and last thought for today. Charlie Munger, who was Warren Buffett's longtime business partner, said, "The big money is not in the buying and selling, but in the waiting." So sometimes we wait and persevere through bad years, and sometimes we wait and enjoy the good years like 2024. So I think the encouragement from me and from Kevin for all of us would be to take 2024 for what it is, an election result that I guess in some ways roughly half the country did not see coming. But I'm not sure that on January 1st, 2024, half the country also would have thought that the S&P 500 index would be up over 21% this year, but it is. The key to successful financial outcomes is not only in waiting, but also in staying focused while you're waiting, staying focused on your financial plan, staying focused on your financial goals, letting those dictate how you invest versus letting one of the many things that we could worry about tell us what to do with our money. It's a great paradox that sometimes we need to let go of control to get control over ourselves. It's not unlike what Dave Ramsey says. You have to tell your money what to do, or it will tell you what to do. So this season, wrapping up the year of 2024 and reflecting, let's stay focused and let's keep waiting well. Let's not forget to enjoy the present reward that we're getting in our portfolios for all the waiting that we've been doing and plan to continue to do. Most of us have seen a lot of volatility these last 5 years, as I said a minute ago. And sometimes the best thing to do is to sit back, be grateful for where we are and where we've been, and just be glad things have gone better more often than they've gone poorly. This is certainly one of those times. So thank you for joining us today. We hope you have a very happy holiday season with your loved ones. And please call us if you have any questions or if we can help in any way. Take care.